Okay, I guess we'll get started. So good day, everyone, and thank you again for joining our Ag Speaker Series. Today's topic is farm family succession. My name is Michelle White, and I'm a financial planner with Innovation Federal Credit Union and Innovation Wealth, along with Aviso Wealth. On behalf of Innovation Federal Credit Union and Innovation Wealth, it's my pleasure to welcome you all to today's webinar. In the spirit of truth and reconciliation, we acknowledge that we are on the traditional territories of many First Nations, Métis, and Inuit who have graced these lands for millennia. We are privileged to work on and enjoy the benefits of these lands, now known as Canada. I join you today from Treaty 4 and the homeland of the Métis. We're very happy to welcome 159 attendees from across Canada to this session. Before I introduce the speaker, I just want to run through a few housekeeping and webinar details. We are using Microsoft Teams for this webinar, so if you're new to Teams, please note that this webinar is being recorded. The recording will be made available on our website after the session, and we'll put the link in the chat for you. For attendees, your video has been turned off and your audio is set to mute. This will allow today's presentation to go as smoothly as possible. We encourage you to ask questions in the chat throughout the session. Our team will monitor your questions and Doug will answer them as time permits. If you have difficulties today at any time, please use the chat to let us know. If in doubt, refresh your browser and exit and rejoin the meeting. Without further ado, I'd like to introduce to you today's speaker, Mr. Doug Carroll. Doug is a tax and estate specialist for Aviso Wealth, Inc., a wealth management partner of credit unions across Canada. He previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug also holds a business degree and a Master of Law specializing in tax. He is qualified as a certified financial planner and an estate trust practitioner. Welcome to the webinar, Doug.
Great. Thank you, Michelle. I'm going to take my mute off there, and I'm going to push my screen up so that it's available to you. Oh, where'd it go? Okay, there we go. I'm just going to wait for you all to show back up again so I can see you on one side, and I've got the PowerPoint presentation up there. I'll just comment on a couple of things here before I get into the content, and I'm just going to push forward for the agenda's topics here so you can see that. On the recording, just so you know, on the recording, for regulatory reasons from the regulatory oversight, the recording can remain up for 30 days. So certainly if there's something that comes up and you don't quite catch it and you want to spend your time just sitting and listening to me again, then you can do that. But it can only remain for 30 days and then it has to be taken down. And then the other thing is we've got a written document that it goes by the same name. I'm delivering the content and I wrote the topic, which is not hugely lengthy, but it goes into these same things in that written piece. So don't feel that you have to be scribbling down wildly every possible point that I raise. That will give you an opportunity to look over things at your own leisure following the session here. So with that, I'll take you through the topic. And again, having given you the opportunity to take a look at the content here, I'll get right into it. The pre-questions that were posed, I've got those that were shared with me, so we will deal with those as we can at the end. And then if any questions get posed during the course of the session, then likewise we'll deal with those that we can. So I want to start just by talking about a non-tax issue, and I do want to make clear. I have no direct farming knowledge. I would embarrass you if you brought up even the most simple farming issue, operational issue, or even intersection of that directly with where the farming part it corresponds with the legal and tax issues. I'm talking here about the tax issues that are available, which I'm quite familiar with succession of farm property, as well as general succession, which, as Michelle mentioned, my past activity decades ago really was a law practice that I ran doing estate planning, where a lot of my time was spent focused on small business as well as seniors. And so despite that I only had a handful of people who had farming interests, I certainly am familiar with business owners generally and entrepreneurs. So just with that as background, before I get into the more technical stuff, and I'm not going to make you pull out your calculators to keep up with me, but I am going to talk about some of the numbers so you get a sense of what is out there available to you to tax manage things more effectively, more so on the transfer than on the year-to-year operations of business. So only on a passing way will I be talking about what happens when you're running the business. I'm more looking at what happens when you pass the business on and what opportunities you have to try to defray the costs that are associated with tax dispositions when you pass on the ownership of the business. So here, the nature of the business is that as a farming business, and again, not to pander to you, but it is certainly a different kind of business than most people in the rest of the economy deal with, because it is both capital intensive, which is a true point to say about business generally, a small business generally, not every single one, but quite often there'll be large capital commitments that will be made in order to generate income, to devote those assets to earn some kind of revenue and then eventually end up with a profit. So that's true of businesses generally. In the case of farming, of course, I'm not telling you anything you don't know way better than I do. That's also land intensive, depending on the operation, even more so in some types of farming businesses than others. And in order to then to make the operation work, you have to take a long-term view of what you're doing to generate that profit. And it may be in early years you are underwater and getting to the point where you are getting to a profitability standpoint, and so you have to make that commitment to the business, to the land, to be able to make that happen. If anywhere the definition of a business as asset rich and cash poor applies, it likely applies most often in farming operations. Again, not with every single one. With some of the operations, obviously, you're at a point where you do operate in an efficient way. Not to say that you're inefficient otherwise, but you're sufficiently efficient and mature, and depending on the nature of the operation, that maybe you're not concerned about that asset-rich, cash-poor condition. But regardless of which way it might operate, any business that is operated, you have this challenge that you have both the goose and the golden egg, so to speak. So the goose being the thing that you own, and the golden egg being the income that is earned off of that. In any kind of a small business where the majority of the effort is placed on running that business as the primary income source for the household, for the family, or broader family even, then you have two things that you're looking at. You are generating income off of the business, and quite often you're investing right back into the business that generates that income. And so that connection between the goose and the golden egg presents you with a different view of things than if you were a straight up employee, even a very well paid employee of somebody else's business operation. You don't have that capital commitment that others have. And then with farming, you have the extra component that, as often as not, you live on the property. You don't use obviously the part that you live on for the farming, but you live on the property, and there's a lifestyle aspect of it that doesn't apply if with somebody who is straight up an employee, or even a business owner who has a commitment to their business but doesn't have their lifestyle, I wouldn't say necessarily dictated, but intertwined with where it is that they're living. So all of that is as background. When you come to the point that you're looking at your succession, I would break it into these three components, like a three-legged stool, that you want to be thinking about yourself, what it is that you're going to do. When I say self, I'm talking about you and spouse, if you have a spouse, whether that's married spouse or it's common law relationships. It doesn't really matter. from the tax standpoint. It certainly doesn't matter in terms of your expectation and intentions of how you're going to spend your later years. Again, likewise, whether you're married or not, you have to be looking at your individual and mutual future, what you're going to be doing. So in terms of your plan, and I'm referring to it as the farmer plan, just so I can have the alliteration of farmer plan, farm plan, and family plan. We're, again, don't think of this as one person. Think of this as being a couple. As you look out into your future, what do you expect that you're going to have in your later years, in your retirement? I've got the word retirement here, but whether you look at it as formally a retirement and no longer working whatsoever, or if it's a transitional, what are you looking at of what you will be doing and how you are going to get to where you're going in terms of your later years? What kind of lifestyle are you intending for yourself, or do you hope to have for yourself? What kind of income would be needed to support that lifestyle? And then how are you going to fund that? Those points perhaps are applicable to anybody who is looking at their retirement years. But again, you have a hard connection to the place where you generated your income in the first place, and perhaps where you are going to continue to generate some of your income. Again, whether it's a transitional type of thing that you're going to ease off in some way if you're transferring to family members and you're still drawing out some of the income or the capital from the operation, or it might be a hard stop that you go from earning that active income and then really just depending upon the money that you've accumulated elsewhere to provide for you. So think about yourself first, and then turn to the farm so that you can evaluate. And again, I imagine that you do this on a regular basis. Make sure that you run an operation which is effectively managed. But effectively managed here, when I'm talking about succession, is something that someone else can take over and run in an effective way. When I talk about business owners, and one of the things I did in my early stage, and this is why I ran a practice where I was dealing with entrepreneurs, I taught entrepreneurship decades ago, mind you, and one of the things about entrepreneurs that I really appreciated was the commitment that entrepreneurs make to their business operation and their energy towards that, as well as the technical skills that they then apply into that. The problem that can come up is that you have someone who is so technically capable and has unique skills that finding a successor who's going to be able to do the same as you're doing with the assets that you're working with can be a challenge. And it's not to say that it's impossible, but it can take some time to come to that determination. If you have a truly unique widget making operation, then maybe it is that there's nobody who's going to be able to do what it is that you do. I suspect that with a farming operation, you might be more effective in some ways than other people, and it might take some time to find someone, or decide among those people around you, but that it's not an impossible task to do. It will, though, take some time. So the operation itself, you want to look at it and determine, not only does it have systems in place so that it operates under your oversight, but also, are those systems sufficiently documented? Are they ready to be taken over by someone else that will then pull the levers, turn the knobs, etc., to make things happen in a similar way that you are doing for yourself? And then who might that be? Who would be the appropriate person, or multiple persons if necessary, who would be able to do that, and how much time might it take to get them to the point that they can actually take over and run it in an efficient way? And then apart from the farm, then the family, whoever your family might be, how do you want to provide for them? The estate that you want to provide for those people that you're taking care of. The person who you intend to be the operator of the farm, Is that person the exact same one person who's going to run the business, or do you have multiple people who you want to provide for? One of the challenges you have, one of the big challenges you have with a farming operation is that appreciating that some components might be divisible, and certainly if you've operated with different geographic locations, different physical plant to run those operations, then maybe it's easy. Maybe you already have that in place. But still, the bulk of your wealth, perhaps, is in farming operations. And so, to that extent, if you have those among your family, if we're talking about providing for your children, your minor children perhaps now, and your adult children as time rolls on, if you're looking at providing for them, those who are not inclined or able to run farming operations, then you might be looking at them and saying, well, if my wealth, the bulk of my wealth is in the farming operations, how do I provide for those others? I can't mimic the large amount of wealth that I have in this 2 million, 5 million, 15 million or so operation with cash that's just sitting off to the side that I can say, oh, I got two kids, one gets this and one gets that. It becomes a little bit more challenging. And it's not really that kind of a one-for-one equalization. And that's why I have the word here, equitization, because you have to be looking at what you feel is appropriate. I hesitate to use the word fair because then that brings in some kind of a moral aspect to it. But practically, if you are looking to equalize, then you might be putting a really significant burden on yourself to come up with money that just does not exist to give equal amounts for the two. The other thing is, as you know, you turn over a business operation to someone, and particularly where you're talking about the intertwined aspects of a farm operation, you're not just giving away wealth, you're giving that person a job to do, to use the capital that you're providing to them to then generate the income, to put the time and effort into pulling out the value from that operation, as well as the lifestyle which you presumably would like them to continue on, that you've had the opportunity to live for yourself. So those are your three components that would be involved in succession. And as I say, having this as a succession stool will remind you that you can't have two of them and not the other. The thing is just not going to work to do it that way. Look at all three of these things so that you can approach it in a practical way. Now, the foundation for anyone's estate planning is to make sure that you have the key documents in place. So I'm not going to go into any great detail with these, but I do want to emphasize a couple of points. Everyone should have wills and powers of attorney. Once you become an adult, then making sure that you have laid out in a formal way who is going to receive what of your property and who is going to be responsible as executor for carrying out that job is what you do with a will. And then powers of attorney operate during your lifetime, where you give to someone else the authority to take care of you and your property, two different documents for those powers of attorney. I'm using the generic phrasing. I know that from province to province, the terms for these documents change a little bit. But you are putting those documents in place to make sure that you are taking care of both yourself during your lifetime and out into the future for yourself, as well as taking care of the people around you, or being conscious of the people around you while you're living, later on, like right now while you're living, later on as you continue to age and perhaps go into decline, and then when you're no longer around for the distribution of your property. So those things are going to apply for everyone for estate planning. And then where we're talking about businesses in particular, and businesses and farming in particular, it may be that you will have more complex legal structures that are in place now or might be put in place. Trust corporations, and then through the movement into those things and the move around those things, there might be a freezing, an estate freeze transaction. Estate freeze is a generic overall term referring to making adjustments to ownership, but freezing taxes in the course of doing so. So not accelerating the point at which tax will apply, making sure that you can put your plans in place and try to cushion the impact of the taxes as much as possible. Certainly, corporations are commonly used in any business operation and in farming, despite that many of the tax benefits associated with the transfer of farms does not require that there be a corporation, whereas if it's a general small business, you'd have to have a corporation. Despite that you don't need a corporation for the transfer, there are reasons why running the business activity through a corporation can be beneficial, both tax beneficial as well as creditor beneficial to do so. And I'll give you some of the numbers on that. Joint ownership of property is something that is quite often thought of when you are looking to transfer on to next generation, to your own children, and that certainly is something that would be part of the mix in looking at what steps you might take, whether you look to do this during the course of your lifetime, or you do it strictly, like if you want to do black and white, only at the point of your death through your will or other mechanisms at the point of your death, or you do combination of these things. So joint ownership will come up, and I'll respond on some of the questions as we get to the end. Life insurance and disability insurance are ways that should you become unable to do things that you need to do to generate the income that comes from the activity, those amounts can then step in and pay out cash that will then stand in for you to do those things. As well, if you're putting life insurance in place, then you want to be looking at what are the tax implications at the point of your death. Many of the tax rules allow for rollover of the values without tax, certainly between spouses and then on to next generation. But if you got a particularly large operation, it may be that there would be taxes that perhaps would be due, or that you might choose to allow for some taxes to be triggered at the point of a person's death so that they can be addressed at that stage rather than having a much larger or continuing tax liability carry on to the successors, whether that's over to spouse or on to next generation. And then, as I mentioned, estate equalization, equitization. If the business is almost entirely the wealth that you have, then having insurance in place, life insurance specifically, can be a way that you can provide for those others who are not going to be involved in the farming operation. The last point here about family law issues, it's always a consideration with any kind of estate planning to make sure that you've protected so that things remain within your family structure, that you don't unnecessarily expose things to matrimonial claims should one of your children have a marriage that goes awry, and potentially that the assets, the property that you're passing on to your children, get caught up in a marital breakdown. That's especially tough when you're talking about farming operations. Again, going back to the point, and again, you know more than I do, you're living on the property, and there are rules that are associated with family law and the rights and values associated with a matrimonial home varies across the country on what the phrasing might be, but there are rules that allow for the spouses to claim the value of the family home, and there can be more than one. If you have multiple properties, a home in town, a recreational property, one or more, they also can qualify in that way. But particularly where you're talking about farming operations, where you've got the place where you live being the place where you also generate the income and have your wealth overall being connected physically, contiguous to the farming operation, that makes things that much more complex. So make sure that as you're looking at your planning, that there is explicit look from the lawyer at the family law issues so that you're comfortable that what you intend to do will actually carry out as much as you can with the protections necessary so that you don't have excessive exposure to family law issues. You may not be able to get away from it entirely, but you want to go into the whole planning process eyes wide open. So as I mentioned, I'm going to show you the numbers here. This is across the country, all of the numbers for corporate taxation versus personal taxation. Fortunately, well, depending on where you are, you can pick out the line that you've got here, and I'm not going to whip through it too quickly. I'm doing the comparison here at top personal tax bracket. And it may very well be that you're not at top bracket, even though you run business through a corporation. But I can't pick out every single income level to show you. I just wanted to explain the benefit of having a corporation for business operations, as well as for excess cash, perhaps, that might be generated through running a business. So if you're at top bracket, and I'll use Saskatchewan down at the bottom here. I mean, it's easier to go to top or bottom for you to try and focus attention. Top bracket is 48%. That's I'm not sure where that is, around 250 or so $1,000 that you're at top bracket. If you were to earn income at that up to that amount, and then for dollars above that, you would pay 48% tax on that. But if you were to run the business activity through corporation, understanding that personally you go up through marginal tax brackets until you hit the 48%. Inside of a corporation, corporations have a flat tax rate that applies to the income that they earn. So if you're running that business and you qualify as a small business, which most farms, smaller farms certainly, would qualify for the small business rate. For the income, I know it's say the federal number. Some of the provinces are a little bit higher, but the federal number is up to $500,000 of active income that you generate in a corporation. You can get the small business rate. So again, keeping with Saskatchewan, you'd only pay 10% tax on the income that you generate at the corporate level. For the amount above that, again, the federal rate, a couple of the provinces are 600,000 or 700,000 for the provincial component. But for the federal rate, if you're up above that at the corporate level, then you'd pay 27%. So the benefit here is when you're reinvesting into the business operation, you're working with, again, my example of Saskatchewan, you're only paying 10% tax, so you can have 90 cents on the dollar that could be reinvested into the business. Understanding, however, that there's two levels of taxation. There's corporate tax, and you have that amount that I'm showing there as the corporate rate. And then when you distribute the money from the corporation out to the shareholder, then there is tax to be paid on breaking through from corporation over to individual. So as you see here, if you have the small business rate on income for Saskatchewan, once the income is distributed out to you personally, then the combination of what was paid corporately and then what you pay on the dividend, it takes you up to 47%. So frictionally, and I've rounded these to integers to not have too many decimal points here, but frictionally, you're a little bit better off by having run through the corporation than if you'd run as a sole proprietor. And really, there's really no difference practically on those two. But in the meanwhile, your ability to reinvest in the business operation, reinvest in the farm, is the difference between the 10% that applies at the corporate level and the otherwise 47% that shows there. So you have that much more that can go back into things. Eventually, you're going to want to take that money out into your personal hands and spend it on all those personal needs, groceries, housing, personal housing, education, whatever it might be. All of those things have to be out of your personal hands in order to do that, although there certainly are some things that you'll spend on from the corporation that are for the business, but then you get some personal usage of those things, and you have to be careful that it's not overly done. For example, vehicles could be purchased at the corporate level. To the extent that you use them personally, then perhaps you have a taxable benefit associated with that, which your accountant can then advise you upon. So there's the benefit operationally to having a corporation in place. So that's what I wanted to make sure that I touch on that, because again, quite often, the fact that you don't need a corporation to be in existence in order to take advantage of the tax rules for succession might suggest to some people that you don't need a corporation whatsoever. And I would probably hesitate to say need a corporation, but you can't benefit from having a corporation. You take your advice from your accountant and your lawyer, what's appropriate for you, but that gives you some of the numbers that are behind why it is that a corporation can be helpful on the operational side of things to get more money invested back into the business. On the transfer of the business, then, of the farming operation, When you sell anything, capital property, from one person to another, or if there's a deemed disposition, meaning that you make the transfer, but there's no payment back in the other direction, and yet the tax system treats it as if it was a disposition, an active disposition, that is what's called a deemed disposition, then there's a capital gain that is paid on that by the person who owns the property, who is subject to the disposition. The difference between what's your cost base, your adjusted cost base, ACB, and the value of what it is that's being transferred. That's your capital gain. And under current rules, half of capital gains are taxable. The change that was proposed a couple of years ago to move up to 2/3, that was rescinded by Mr. Carney around about this time last year, when he became both the leader of the Liberals and then the Prime Minister. And so we are still at the point where we have capital gains being 1/2 taxable. Where you run a business, a small business, and you have shares in a corporation, or if you are running something which is a farming or fisheries operation, then you are entitled to the lifetime capital gains exemption. That's a per person entitlement. So if you had one person owning a business and you had a capital gain up to this amount, this is indexed from year to year, right now $1.275 million in 2026. It's indexed based on the same index factors that apply to tax bracket changes. So last year it was 1.25 million. Yeah, it was 1.25. Now it's 1.275. And again, it'll keep indexing upward over the course of time. So if you have a capital gain on a disposition that is no more than this, then you're going to be able to use the lifetime capital gains exemption in order to not be taxed on that gain. If you have multiple people owning the farm, or the qualified farm property, each person is entitled to this exemption. It's not based on the assets, but it's on a per person basis that this can be used, which means that if you are inclined to hold everything close to the vest and you personally alone have the ownership interest, then you may be giving up on some very significant tax benefits if you were to share the ownership with others around you, obviously not somebody just down the street, but others around you who are part of your family that could benefit from this. And if they are, as they most likely are, the eventual heirs of you, then involving them in the ownership can be something that allows you to mutually get the tax benefits. And depending on how comfortable or uncomfortable you are with them having outright ownership, then you could use some other ways to maintain control yourself, not share out all aspects of ownership with those other people, those family members, your children, your grandchildren, and perhaps have terms of how a corporation would operate, or trusts holding shares of the corporation for one or more of those people, you being the trustee over that trust, so that you can get the tax benefits without again giving out the full legal rights and control that perhaps could get in the way of you running the operation yourself. So in addition to, oh yeah. Yep.
Sorry, Doug, just to interrupt, because since you are talking specifically about this, there was a question that just popped into the chat. So are small corporations also eligible for this lifetime capital gains exemption, just since you're already on the topic?
Yeah, so the for the capital gains exemption, for the corporate side of things. Okay, so let's leave aside the farming, and I'll talk about the components of farming in a second. But in terms of the corporation, you have to be first what's called a Canadian controlled private corporation in order to potentially get the capital gains exemption. A Canadian controlled private corporation is one that is not controlled by either foreigners or public corporations, or a combination of those. That's what gets you that small business rate. So going back to the numbers I was showing you earlier, you get the 10% rate on your operational activities if you are a CCPC. And then if you are a CCPC and there is a disposition of the shares that you own, then the shares, just to throw, this is actually in that written piece, don't worry about this. The shares that you own, if they qualify as qualifying small business corporation shares, QSBC, then you'll be able to claim the LCGE. That one's up on screen, so I don't feel so bad about putting that up, saying that. To be qualified as QSBC shares, then the main requirements are that at the point of the sale or the deemed disposition of the assets, then at least 90% of the capital in the corporation, that the shares that you own, at least 90% of the capital is devoted towards active business income producing purposes. And over the 2 years prior to the disposition, on average, at least 50%, 50, are devoted towards active business income production. Where that matters for in terms of those thresholds for business owners generally with corporations is that if you have a lot of excess cash in the corporation and you decide that you want to put that into an investment portfolio within the corporation, which you are entitled to do, you, to the extent that you build up a lot of that cash value, which is not going back into the business or isn't available to go back into the business, you might lose your ability to claim the capital gains exemption on that. And so you have to be very careful about what you do with those excess cash amounts. Commonly what people will do is set up a layer of corporations. So you'll have your operating company, which you keep clean, and then you push dividends from your operating company into a higher level company that owns shares of the operating company, a parent company. Sometimes people refer to it as a holding company. And then you could invest those dollars at the higher level holding company level and still be able to keep the operational corporation available for the capital gains exemption. Again, if the corporation goes offside, all of the shareholders are in peril in that situation. So you want to make sure that you are aware, with the combination of your lawyer and your accountant and your financial advisor, that there is excess cash before you invest that money, because you could end up with some money that's built up in value inside of your operating company that then, in order to clean things up, will have to be moved out, which will then cause a disposition of those assets, and you'll trigger tax on those dispositions of the investment account assets. So you want to make sure at the front end of things you're reasonably clear with their guidance of what the implications might be, and then you reorganize or create the necessary structures that fit your circumstances. Was there someone else there that asked a question, or was it?
Yes, there's a couple more questions, follow-up questions to that in the chat. So just to confirm, in the corporation, it's each shareholder gets that lifetime capital gains exemption, not just specific to the corporation, correct, Doug?
Yes, that's okay. Right.
Perfect. And then another question was, so if an individual has claimed 500,000 of the capital gains exemption, can the same individual 10 years later claim the remaining amount? Example, dad deems sale to Corp A of 1 quarter, and then 10 years later makes another quarter sale.
Okay, so without getting into the example directly, yeah, if the capital gains exemption has been claimed, and we'll just use that number 500,000 because we know it's now just a little over 1.25 million. So if at some point in time in the past, when it was 500, that was claimed by someone, then as the capital gains exemption continues to rise in the intervening years and index from here forward, that person on a later disposition, assuming that there has been that much more growth, could claim the other roughly 700,000 at this point in time if there was a qualifying disposition. So that is something that can happen, where where there might be an estate freeze transaction that takes advantage of the capital gains exemption in bumping up the cost base of the holdings of someone, that then a decade or a couple of decades later turns into another transaction or another move that would like to be made to try to again rearrange things. So yes, the future growth of the capital gains exemption could be used by someone who used the capital gains exemption in the past. So it's not a matter of I outright use my capital gains exemption and I use it at a certain dollar level and I can't access it again. You can use it for those later amounts. So on these other cost considerations, I'm going to leave those alone. I'll just make a brief point on these, that these things are considerations when you are selling a business. So despite that, you might be able to claim the capital gains exemption. There are other things that might be imposed. Land transfer tax, depending on province and what the phrasing is, the formal phrasing. When assets are sold rather than land, then there might be commodity tax, GST, HST on those. If you are at a high income level, then you might lose your old age security for a time because you have a large sale of property. The biggest concern though is alternative minimum tax, and that's something which I am going to talk. I think that's my next point that I've got here: alternative minimum tax. So alternative minimum tax is a parallel tax calculation. It actually happens all the time. It's just that for the majority of the population, it's not relevant because the regular tax calculation is going to be more than what the alternative calculation will be. And it's referred to as either alternative minimum tax or just minimum tax. And what it does is it allows for the tax system to make sure that where you have extra tax benefits that have reduced down your otherwise tax bill to a lower level, that in fact you do pay, from a tax policy standpoint, that you do pay tax in a year when you have a large amount of income. So what it does is it adds back things that are preferred treatment that happen in your regular tax calculation to then determine whether you're subject to this alternative tax. And the things that are added back are the things that I've just been talking about to a large extent. The non-taxed half of capital gains is included in this this calculation. And when that happens, despite that you are able to claim the capital gains exemption, so the I'll just call it $1.25 million capital gains exemption, if you'd claim that much, that's great that you're not going to pay tax on that exemption under the regular tax calculation. But in the background calculation of the alternative minimum tax, you may break through the point where you nonetheless do have tax that you have to pay based on this alternative minimum tax. And what happens with that is, you see the highlighted numbers here. It adds back these other tax preferred items. These aren't the only ones, but these are the big ones. It adds back those items, and then you get an exemption off of that. So just thinking of our personal taxes, we have a personal tax a credit, which is somewhere, again, depends on province, let's say in the mid-teens, 16,000. It's roughly around 16 or 17,000 federally, and then each of the provinces has an amount upon which you pay no tax whatsoever before the tax brackets then apply. Here, it's much more than 16,000. It's about 10 times that. It's the federal, the fourth federal bracket level, which is 181,000. So you get that first as a deduction, and then you multiply the difference of what the revenue or the gross amount is minus that deduction times 20.5%, which is the second bracket, second federal bracket level. So this is something which I know people find it offensive. It's like, oh my gosh, first I'm going to pay tax, and then if I try to do things not to pay tax, then I'm going to pay tax anyway. This is not intended to hit you with extra taxes. It is intended to be recoverable by a person. And the recovery then happens over the course of the next 7 years. So the amount that you pay as minimum tax is then a pool of money an account, which then can be used as a credit against future taxes over the course of those next 7 years. The problem you can get into, and this is why you got to be talking to your accountant about this before you are on the verge of stopping working altogether. The problem you can get into is if you outright retire and you're not going to have any significant income after the point when you sell the farming operation or transfer the farming operation, and if minimum tax applies, then you may not be able to soak up that 7 years of tax credit if you don't have taxable income in those coming years. So it's a bit of a challenge, perhaps, to anticipate it and set yourself up to be able to not trigger as much as otherwise would apply, and to make sure that the way that you take your later income, it brings into account the fact of the minimum tax if it applied and how you are going to recover that over the course of the coming years. So that's going to be a conversation again, mainly when you have the conversation with your accountant, who will guide you on the numbers. It's not that it's just on the point that somebody has raised here about when is minimum tax triggered. It's not that it's triggered in any way. It's always a background calculation that happens with the regular calculation of your taxes. So if you've got a lot of these tax beneficial features like capital gains, and particularly capital gains where you don't have where you don't have to pay on them because of the capital gains exemption, then the background calculation will determine whether you have alternative minimum tax that is due, even though you might have a lower amount of standard calculation of tax that would apply. Okay, now one of the things that you have available to everybody is the principal residence exemption. So all of us on the sale of the property, which is our principal residence, we don't pay tax on that gain. There are two methods for calculating that for people who own farm property. I don't know how relevant this is anymore. Back when this was put in place, back in the decades and decades ago, you can see what the figures are. You have, of the property that you own, a half hectare of the property could be earmarked as being the principal residence if it's one parcel of land. Of that parcel of land, half hectare can be allocated as principal residence, and that part, irrespective of any claim you might have for the farm property under the capital gains exemption, the general capital gains exemption or lifetime capital gains exemption, that portion would be protected from capital gains taxation because of the principal residence exemption. So there's two ways that it's calculated. The second way, based on the dollar amounts here, $1,000 plus $1,000 of exemption for every year after 1971. I think that property values, to be honest, have accelerated so much that most often I think the half hectare portion of this rule would be the one that applies. I think that's probably just going to confuse you if you try to work that through your head or understand where I'm going with that. It's a conversation again to have with your accountant, and it's whichever is best is what's going to be chosen. You don't have to make a decision beforehand. Do understand though that if you own your residence inside of a corporation or a partnership, the principal residence exemption is available to personally owned properties, not to ownership through partnerships or corporations. Corporations, definitely. There may be some workaround that is available if you own through a partnership. Be aware of that, though, because I've certainly seen it. It's not like I directly consult with people on a very regular basis, but I have conversations with financial advisors where some of these issues come up. We identify issues so that the person can go back and have the conversation with their accountant or lawyer in a more informed way. I've seen it where just because the corporation, for operational purposes, gave them the small business rate that, or even just the general corporate rate that was lower than their otherwise personal corporate rate, they generate a lot of income in the corporation, which allowed them to build the operation because the reinvestment of more money allowed by that. But then when there was surplus cash, the surplus cash then was used to purchase or build a home on the property, build another home perhaps in addition to the home that had previously been where they had lived. And because the money in the corporation was used for that purpose, principal residence exemption was not available on that. That's not to say that that was a bad decision. It was just part of the calculus perhaps that should have gone on, or maybe did, on the decision whether to use the corporate money to do that building or acquisition of the residence, or if that money might have been better to have been dividended out subject to tax, and then the purchase of the land or the development of the land for the residents may have been then in personal hands. So just be aware that that there's a lot of interaction with these rules that cause you to perhaps adjust where you think might be a good idea on a front end of putting something in place. Whenever I hear the phrase tax efficient, I always bristle, because I always ask, well, what do you mean by tax efficient? You mean you're paying less tax right now, or do you mean overall over the course of time you are optimizing the tax payment between you and future you, or between you and the people around you? What do you mean by that? Make sure that you understand the full picture before you go ahead and make changes. And for those of you who perhaps have not disposed of a property, and I imagine that's a lot of you, in the last 10 years, since 2016, the tax rules require that there be a detailed rundown of the ownership of the property, and particularly where you've got land, obviously, where you got, again, contiguous residents with farm property on the same parcel. Then it's going to be really important that you can show what was paid for what in the course of time, so that you can properly report over to CRA and make sure that you can claim your principal residence exemption. So the record keeping is really important. Now, what's qualifying farm property? The first line here are the things that qualify, and this is it's way too complex to try to get into great detail here. But the main thing is the distinction between the first line, land, buildings, quota, and certain intangibles qualifying as qualifying farm property for the capital gains exemption, but not things like the equipment like tractors, thrashers, and other things that are used on the farm. Those types of things are not qualifying farm property. However, if those non-qualifying things are owned through a corporation or a partnership, they may then qualify for as being qualifying farm property. In particular, if they're inside of a corporation, if the corporation is doing business which qualifies under the Canadian Controlled Private Corporation as an active business that you've got going on there, then those things that are inside the corporation may very well qualify for the corporation-based capital gains exemption, as opposed to the entirely not distinct, but under the category of farm property directly. In order to claim the capital gains exemption for farm property, there is a line in the sand that was drawn back in 1987, where the ability to claim that property, or claim for the qualifying conditions, was made more stringent subsequent to this date, June 18th, 1987. Again, this isn't going to mean a lot with a one-liner, but if you acquired your property before that date, then it's easier to qualify as qualifying farm property. If it was after that date, and it would be something where you may have done some farming and occasionally, but not a lot since that time, then you may not qualify for the qualifying farm property, which then feeds into the capital gains exemption and a couple of the other things that I'm going to touch on transfers to family members. So be aware of that. Again, there's a little bit more detailed rundown in the written document that we're sharing with you. For transfers of property to others in your family, certainly with a spouse, you can transfer over to a spouse, and this is true of anyone, you can transfer capital property to a spouse and do that at cost base. So you don't trigger a tax liability at that time. Your spouse takes over at your own cost base. So you've deferred off the taxation of that. Now, if you transfer for free to your spouse and your spouse then sells that asset that we're talking about, then the capital gain on that will be attributed back to you as the source. So it's not just a quickie, all right, we're just going to change the names here, and then we're going to sell the whole thing off to someone else, and now we've split the capital gain. You still have an attribution concern to deal with, and so transfers even between spouses should have tax legal guidance before doing so, because you certainly can transfer over assets so that despite that you transfer over it at cost base, you can cause or set up for the future capital gains to be in the hands of the spouse as opposed to the original owner of that property. So be very conscious of the need for proper advice. And then with family members, then for farming property here, I'm not talking about capital assets generally now. With spouse, I'm talking about any capital assets. With family members, and particularly children, then if you have property which you are transferring to them, which is used in farming or fishing, then you can roll over to them at your cost base. So not trigger taxes when you roll to them. So it's a different thing than the capital gains exemption where there's a disposition. This is transferring over to them so that they take over ownership, but there's no tax that applies on that. They take your relatively small, let's say, cost base when that happens. So there is a weighting capital gain that happens when you transfer over to them. So you want to be conscious of that, because what you might want to do is a more elaborate setup where you transfer over to them, but you trigger some of those capital gains so that your own capital gains exemption will increase the cost base. Still, in ideal circumstance, you don't have any tax applying at the time of the transaction, or maybe a series of transactions. You do then allow for your children to have a higher cost base upon which an eventual later capital gain will or may be calculated. Again, understanding that each person gets the capital gains exemption, but you're putting them in a better tax position by making use of the capital gains exemption in the course of these transfers. And when I say child, as you see here, there is a broad definition of child. It can be down a couple of generations: child, grandchild, great grandchild, and it can include where perhaps you're in a second relationship with someone. So you've had your separate children. It can include that person's children. It can also include spouses of any of these defined people. So it's a fairly broad opportunity that you have to make use of that transfer at cost base. And then one of the other things that can happen, again, coming back to what I was saying at the very beginning, or almost the very beginning, about the three-legged stool, taking care of yourself, you the farmer, as well as the farming operation, as well as the family. If you need the money, the capital and or the income off the operation to live in your later years, well, it might be really nice of you to just transfer everything over tax-free to everybody else and then stand back and go into the soup line. But likely you're going to want to take care of yourself first, or you should be thinking about yourself in conjunction with being tax effective in the way that you carry these things out. So what you can do is perhaps set things up, and you'd want to have a really good avenue looking forward of how you're going to do this, that some of the transfer might happen on a rollover basis, but also some of it may happen as a purchase. And when it happens as a purchase, when you have the sale of capital property general rule, again, irrespective of whether you're farming or not, general assets, when you sell things to somebody who is at arm's length, then if the payments from that person carry out over a period of time, then you can have up to 5 years that you can spread the recognition of the capital gain according to how you get paid on that thing, to reduce down your tax liability. If this is somebody totally at arm's length, then that may not be something where you want to have the risk they won't pay you, but it's possible to do that. Whereas when you're talking about farm property and you are transferring to someone who is purchasing from you as a child, in that long definition that I gave you there, then you have up to 10 years that the payments can be made and then can defer off the recognition to the person who is the seller, the original owner of that property. And if we're talking about a couple, then hopefully you both own part of it. And so that could then both spread out the tax liability between two people, as well as spread out over the course of time. So the operation of this is that you have to recognize at least as much on a year-to-year basis. So it can be an equal amount over a course of time. What you can't do is say, okay, well, in year number 1, they're going to pay $1 and then $2 and then $3 and then 10 million in year number 10. That's not going to work. You have to have even recognition, at least in the simplest calculation, at least 10% of the recognition in year number 1. Year number 2 or later cannot be higher than what's been recognized in a previous year. That takes us pretty much up to time here. Excuse me. I don't know who wants to step back in again, Cavell or Michelle, but I'll stop there. And I don't know. I'm okay to hang around for a bit and try and deal with questions, but I'll shoot it back to you.
For sure. So we'll just quickly remind people if they do have, we've got a couple minutes left, or if you want to stick around a little bit longer and post a question in the chat. We did have a number of questions come in prior to the session, so you were able to pre-submit. But looking through them, I think you really handled all of them very well within the presentation.
Yeah, as I was looking at them, I think that not to the word, but I think that they fell within most of the commentary that I've got here. And if somebody's got a further question, they can send that to you, and you and I can work on getting it back to them.
Yeah, absolutely. So unless because I'm not seeing anything else come up, I can hand it back to Michelle and she can do the wrap up.
Thanks, Cavell. Thanks, Doug, for your insights on this very important topic. For me personally, I think what I took away from today was that as the farmer, as the business owner, you really need to put yourself first when it comes time for succession planning. And you need to make sure that you're preparing those power of attorneys so that you can have somebody help you if the need arises today, and that you've also got that will in place so that your wishes can help to be ensured that they are carried forward into the future, right? The biggest thing too is that it doesn't happen overnight. It takes time to do a succession plan, and you need to work with all of your partners. You need to work with your financial planner. You need to work with your accountant, and you also really need to work with your lawyer. So between the three of them, they can really help you get that succession plan in place. So I'm confident with the information that you offered today was going to be helpful to our farmers and to their successors on the call, and that this information will help shape their conversations with their families and for future succession plan. And I guess the other big thing is you really need to have those conversations with your family. That's so important. So everybody understands what page you're on and why you're seeing the things go the way you would really like to see them go. We greatly appreciate the expertise you have shared with us today. So before everybody signs off, I just want to let you know that you will be receiving a survey about today's webinar, and we would greatly appreciate your feedback. Watch your inbox for the opportunity to share your thoughts and suggestions for our planning team. So on behalf of Innovation Federal Credit Union and Innovation Wealth, we thank you very much for attending today. And we hope to see you in future Ag Speaker Series presentations. So thanks again, and everybody have a great day.